Hello, I'm Vidya, your tutor. Let's learn bank reconciliation statement together, step by step. Hello, I am Vidya. A business keeps its own cash book and the bank keeps a passbook. Often these two show different bank balances. In this chapter, we learn why they differ and how a bank reconciliation statement reconciles them. A bank reconciliation statement, or BRS, is a statement that explains the difference between the bank balance as per the cash book and as per the passbook on a given date. Preparing it helps detect errors, delays, and even fraud, ensuring our records are reliable. Differences arise from timing and entries known to only one party. Checks issued but not yet presented, checks deposited but not yet cleared, and bank charges or interest credited directly by the bank are common reasons the two balances disagree. To reconcile, we start with the balance shown by one book, then add or subtract each cause of difference, and finally arrive at the balance shown by the other book. We must think carefully about whether each item raises or lowers that starting balance. Suppose the cash book shows 10,000 rupees. A check of 2,000 was issued, but not yet presented, so the bank has not reduced its balance. We add this 2,000 to 10,000, giving a passbook balance of 12,000. The records now agree. Sometimes we first prepare an adjusted or amended cash book. We enter items the business missed, like bank charges, interest, and direct collections, to update the cash book balance. Then we prepare the reconciliation statement from this corrected balance. To recap, a bank reconciliation statement explains why the cash book and passbook balances differ, mainly due to timing and one-sided entries. By adding or subtracting each cause from a starting balance, we reconcile the two and confirm our records are accurate. Great work! Keep learning with Vidya and visit CBSETest.com for free lessons, worked examples, and practice tests.